So here, when we look at China, we want to talk about what's happening with China right now in terms of coming out of their zero COVID and the lockdown starting to ease a bit. So you're starting to see some of that bounce, but it's going to be the pace in which there's a recovery, which we think is going to be a bit slower this time around versus what we saw in 2020. Because again, they issued a lot of stimulus coming out of the first slowdown, the first lockdown, and there was no tightening. And again, they haven't tightened in so long that the impacts that they're going to get from this new stimulus, again, is going to be difficult, especially given because the local governments and the local provinces are being pulled in so many different directions. There's a lot of confusion as to, okay, well, what is the goal? But when you look at the U.S., and I think this is important just because obviously the U.S. is the largest buyer in the world and a huge trade partner for China. When you look at input costs, particularly grain, oil, dairy, and protein, are rising faster than can be passed along at retail and food services with no relief in sight. Now, as those input costs go up, that means that consumers in the U.S. will have less money to spend elsewhere, and I think is a much bigger problem when you look at where things are, as price increases haven't let up in other areas. So when you look at 2022, there was a view that things were going to be better. And for those that have been following us, which I don't mean to come across as doom and gloom, we've been saying it's like they're not. They're going to continue to be a problem. And it has been. And the question is now what happens next in terms of where things are going overall. And that leads us to industrial profits in China, which were negative 8.5% in April and will likely be negative again in May. So the composite PMI came in at 48.4, and it's still below 50, so it's still contraction, but again, still a positive versus where we were, which was 42.7. Manufacturing PMI was expected at 49, came in at 49.6. So again, manufacturing picking up a bit, but it never dipped as much. But when you look at non-manufacturing, that dipped the most because, again, consumers couldn't do anything. They were literally bolted into their homes and their apartment buildings. So now, as you were allowed out, you're going to try to make up for what inventories were drawn down. How much food do you need? How much clothing? How much stuff do you need that again you've been waiting to get? So that came in at 47.8. So the expectation was for 45.5. So still a bigger increase. Now the CAC in China PMI manufacturing was expected at 49, came in at 48.1. So again, you're starting to see some of that balancing act. And the question is, how quickly do we get that snapback? But just the bottom line is local governments are confused about how to thread the needle on stimulus, because it's hard when you look at growth and how you'll get there at the end of the year, because how do you prevent further COVID outbreaks? But you have to deploy capital, in good projects that yield a return. But projects over the last 4 years, at this point 6 years, have been hard to come by because a lot of the good projects were already financed back from 2012 to 2018. So how am I going to deploy this capital while you're cutting taxes, so taking away some of my cash flow? The real estate market is terrible. So my biggest revenue driver for the last 15 years has been real estate sales. That's now gone. Plus unemployment is up. So I still have to pay out. So where is the money coming from? But at the State Council, 33-point economic support plan, which was unveiled on the 23rd, and then at the emergency May 25th teleconference with local officials trying to describe it. So there's 33 policy initiatives across 6 different areas. 7 initiatives for fiscal policy, 5 for monetary and financial policy, 6 for stabilizing investments and spurring consumption. We keep hearing about consumption. 5 for ensuring food and energy security. Again, food is going to be the big piece of this. 7 for stabilizing industrial supply chains. 3 for protecting people's basic livelihoods. Many of the measures are aimed at easing the burden on hard-hit sectors, upping tax rebates for manufacturing, energy, and aviation. Again, upping rebates, tax rebates. So this is tax money going back, which is how is this going to be structured? The measures also include stimulative moves, accelerating the issue of special purpose bonds, which again, it's the problem of who am I selling them to and who actually wants them, because right now supply isn't the issue, but demand. So when you look at further pushing down lending rates, that's the view of if they push down lending rates, they'll incentivize more people, more companies to borrow. But many of them are already so levered, encouraging banks to extend loan repayments for small firms. Again, so you're extending loan payments. So that means that the non-performing loans are going to stay on my balance sheet longer, and you want me to issue new debt. It's like, okay, that's counterintuitive in terms of where things are. Increased financial institution support for infrastructure construction, which has had a negative multiplier effect since essentially 2018, which again is that underlying pressure that we continue to talk about. So then when you start looking at the PMIs, you can see that we're still bouncing up. You're still negative, but increasing. But look at 2021. 2021 was bounced back and forth between slight expansion, slight decline, slight contraction. There hasn't been any perpetual growth, with new export orders bouncing, yes, but still deeply negative in terms of contraction. And look at 2021. Over half the year was in contraction. So again, there's been that underlying slowdown of exports and new orders, which is why we've been so concerned on expansion in 2022. So then when you look at the PMI surveys, you get an idea of, again, where things are in terms of services. You've had that steep drop off, but the manufacturing side, all of these things continue to contract. And if you look at 2021, you had a slowdown in services prior to the breakout of COVID, the lockdown. So again, you were already moving in the wrong direction. Now, the post-lockdown recovery has diverged from 2020. The congestion side, in terms of people going back out, people were more excited to get back out, but at the same time, they had to go out and get their stuff. But property sales, in terms of where they are in congestion, they never really dipped the same way when you look at in terms of people looking, but nobody's buying. And that's the biggest problem when you look at property sales in general, because congestion in 2020, property sales, you had both of them coming back up. 2022 is very different. And that's the biggest problem, is nobody's willing to take that debt. Nobody's willing to take those loans. So even though people are still looking, you don't have any actual buyers, which is the problem. The Greenland bonds, coming in steeply negative again, as they said they weren't going to be able to meet their interest payments. And now coupons on Chinese SOEs or state-owned enterprise new bonds have hit a record low because they're seen as safety. They're state-owned enterprises, so that's going to put more pressure on even the large conglomerates, and you're starting to see that pressure continue to move down. But the annual change in new household loans contracted the most in April. Medium and long-term consumer loans, residential floor space, annual change in new household loans, again, steep drop-off. Household marginal propensity to consume, steep drop-off. But look at the pace in which the marginal propensity to consume has been. It's been at a downward trajectory since 2017. And that was when they really kind of peaked out the amount of borrowing that they were willing to do. Then you had people taking a ton of new household loans in 2020, which again is now everybody is tapped out on the consumer side. So even though they keep talking about wanting to promote more consumption, it's going to be difficult to actually do that based on how the consumer looks. But then the corporate demand for credit remains depressed. Banking Climate Index, loan demand minus loan approvals, flatline. Corporate medium and long-term loans continuing to contract. New increase in corporate bill financing as a percentage of new bank loans has gone up. So you're looking at shorter-term financing, don't want long-term, trying to reduce their underlying leverage ratios, but again, moving in the wrong direction. And it's just, there's not the demand for it. The supply is there, but that's why they're going to try to knock down those rates again. China's credit impulse, has flatlined. As we've been saying, it's still negative, but what we've been saying is it's just going to stay at a fairly tight band, and it's going to support some of the base metals. It's going to support some of the activity, but it's more of a flatlining and not this big surge that I think people are talking about, especially when you look at the non-performing loans as we got into the end of 2021, and it hasn't gotten any better in 2022. So you had 2021 getting much worse, and now it's getting worse again in the first 2 quarters of Q2 of 2022, but yet they want them to issue more bonds, more debt, which again becomes an underlying problem, especially as the China real estate price index continues to hit a new low. And that just means that the assets that are currently on the sheets that are acting as collateral are declining, increasing the amount of non-performing loans and the leverage that is on your balance sheet. And then when you look at residential commodity buildings, floor space sold at a negative, started negative, completed negative, land purchased steeply negative. And that's where it comes back down to the provinces and local cities and local governments. That's how they've been making money. They've been selling land, using that revenue to help finance a lot of these things of special purpose bonds and other stimulus, directives. But how are you going to do that if you can't sell any land? If you've seen this dry up, again, creating these underlying problems. Now, Chinese manufacturing output and capacity utilization. So industrial capacity utilization coming down. Exports, again, it's more of a trend type thing, where exports are going to continue to diminish, as we talked earlier, which again is going to shrink some of the underlying industrial capacity. Now, Vietnam, exports were expected to be at 25.6, came in at 16.4, but the imports is the bigger problem because the exports were expected to be at 15, they came in at 12.9. So remember, imports are that leading indicator for exports. So we do see some contraction. They'll still stay positive, but again, we do see some of those underlying issues. Industrial production still staying strong, but CPI starting to creep a little bit higher. You're starting to see some of the pressure with retail sales still remaining strong. So again, Vietnam is still in a good position, but on the trade side, which is a leading indicator for them, starting to see some slowdown, starting to see some cracks. So that's going to be a key one to watch to see how much it worsens. Now, South Korea retail sales year over year came in fairly strong. Discount store sales also stronger, but then you have industrial production was expected to be at negative 1.2, came in at negative 3.3. So again, your leading index change, starting to see some of those slowdowns, but now, one of the pieces on why we're not too concerned is exports, imports. So exports were expected to be at 18.4%, came in at 21.3%, and imports expected 31.4%, came in at 32%. Again, leading indicators. So South Korea still remains in a fairly decent spot when you're looking at industrial production because their export markets are still remain open to them in terms of trying to get them into the market. But you still have, again, South Korean bank rates continuing to go up. They increased at another 25 basis points in line with expectations, but the risk of CPI went much higher. So the Bank of Korea took their expectations up, which just means that they're going to remain aggressive on raising rates, which will cool some of the activity within the country. But based on exports, we expect that to be fairly robust. Now, the problem is some of the imports from China have dipped, which is a bit of a leading indicator. So we do expect exports, imports to soften a touch, but again, nothing that's going to be concerning because there's still a decent amount of demand in the market. Now, this is just showing that dip in industrial production. There's still, again, you can see it's fairly lumpy. We do expect to see this come back. It'll still be slightly negative just given the slowdown in May on imports from China. But again, which they import semi-finished goods, assemble, export finished goods. So that'll just show a little bit of that slowdown, but still in a fairly decent spot. South Korea exports by dollar amount, you can see down a bit from the high, but again, still moving at a very strong pace. Now, Japanese consumer confidence bounced a bit, but still, again, fairly stable, a bit depressed on that side. CPI, again, creeping a bit higher, but still in a fairly comfortable spot. The problem is the service PPI. So the producer price index was expected at 1.5, came in at 1.7, and that was for April. We see that accelerating again in May and June, which is going to compress, again, some of those underlying margins. As CPI, the survey was for 0.9, came in at 0.9, and you can see that in May it accelerated, and that's where, again, for the PPI side, we see that going up again. And again, they're going to feed off of each other, and we do expect those to continue to move up. Now, India, when you look at the GDP year over year, we expected to see growth. We got some growth. It was expected at 3.9, came in at 4.1. The issue is going forward where we see a lot of the pressure as inflation really starts to hit hard. And that's when you start looking at some of the 8 infrastructure industries, came in at 8.4% in April. And then India manufacturing was expected to be at about 54.6, came in right in line, slightly down from April, but still fairly robust in May. But a lot of that was driven based on prices. And that is, again, that leading indicator for inflation, with India 8 core industries output index remaining elevated. But India's sales of gasoline and diesel in May rose as tax cuts on the transport fuels helped boost consumption. A heat wave earlier this month also incentivized people to be in their cars. Gasoline sales by the 3 biggest retailers were at 2.8 million tons, up 8.2% month on month and 12% higher than the corresponding period in 19. But overall diesel sales were at 6.83 tons, came in at 1.8% month on month. However, daily sales over the 31 days of May were 1.5% lower than April, which has 30 days. Sales were negative 2.3% compared with 2019. So diesel's a better measure of kind of where things are for the industrial side. So again, it's a little bit of weakness, a little bit of slowdown. We think this is going to accelerate and become a bigger issue in India as we go through the end of the year, as inflation is now firmly above 7%. And we see that staying when you look at vegetable oils and other key inputs, which is why, again, India is a concern. So that's what we have for you today. If you have any questions, again, you can find us on the comment section on Twitter. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Revision Network.